A single Reddit post about commuting costs bankrupting families has revealed something Wall Street is overlooking. Suburban housing markets are about to experience 15-25% price corrections as workers flee unsustainable commutes. This is Market Pulse Desk. We're analyzing economic data, sector rotation patterns, and real estate market indicators to identify which regional housing markets are most vulnerable to collapse. Everything you're about to hear is sourced from public economic data, Federal Reserve surveys, and Bureau of Labor Statistics reports. This is educational research, not investment advice. Let's start with the viral Reddit moment that triggered this analysis. Last month, a post in r/personnel finance went viral with over 47,000 upvotes. A household earning a combined $165,000 annually in the Phoenix metro area detailed how their commute, a 52-mile round trip from their affordable suburban home to downtown jobs, was destroying their finances. Gas, vehicle maintenance, insurance, tolls, and wear and tear added up to $18,400 per year. That's 11% of their gross household income spent exclusively on moving between home and work. But here's what made that post significant. The comments revealed this wasn't a Phoenix problem. It was a nationwide suburban pattern. Hundreds of households reported similar situations in Austin, Nashville, Atlanta exurbs, inland Southern California, and Denver satellite communities. Research data confirms this is systemic. According to Bureau of Labor Statistics consumer expenditure data from 2024, households in sprawling metropolitan areas now spend an average of $12,000 to $18,000 annually on transportation, with commuting representing 60-70% of that total. That's a shift. In 2015, the average was closer to $9,000 across the same metro areas. The Federal Reserve's 2023 Household Economics and Decision-Making Survey found something alarming. 34% of households earning between $60,000 and $100,000 annually now describe their commute as unaffordable or unsustainable. In 2019, that number was 12%. That's a 182% increase in households experiencing commute stress in just 4 years. Now, let's connect this to real estate prices and identify which markets are about to crack. During the pandemic, a specific pattern emerged. Remote work adoption hit 44% of the workforce in 2020-2021. This created an unprecedented surge in suburban home demand. Households thought, I can work from home 3 days a week. I can afford a bigger house 45 miles from the office. Developers and builders responded. Construction in suburban zones outside major metros increased 34% from 2019 to 2022. But remote work adoption never stayed at pandemic levels. According to ADP employment data, remote work has now plateaued at 28% of the workforce nationally. And that includes company-wide remote teams where commuting isn't relevant. For traditional office-based employment, hybrid work is dominant, meaning employees are in the office 3-4 days per week. This means that house purchased 52 miles from the office in 2021, with the assumption of 2 days in office, is now requiring 4 days in office. The commute math changed, but the house price didn't adjust yet. Research shows this is creating a predictable market vulnerability in specific regions. Let's identify the 3 highest risk markets based on data analysis. First, Austin metropolitan area exurbs. Data from the Austin Board of Realtors and Zillow Home Value Index shows that homes in satellite communities like Bastrop, Lockhart, and Dripping Springs experienced price appreciation of 28-42% from 2019 to 2022. These aren't downtown Austin prices. These are 45-70-mile commute communities. The median home price in these zones increased from $285,000 to $412,000 in 3 years. But Tesla's recent announcements about reducing remote work, combined with broader tech slowdown affecting Austin's job market, have created a visible pause in demand. Days on market for homes in these exurb zones increased from 21 days 2022, to 47 days, 2024. That's a 124% increase. When inventory stays on market longer, price pressure follows. Research on historical corrections in overbuilt suburban zones suggests vulnerability of 18–25% from peak valuations. Second, Phoenix exurbs, Gilbert, Queen Creek, and Maricopa. These markets experienced 35–48% appreciation during 2019–2022. The median home price in Queen Creek jumped from $315,000 to $428,000. The household in our Reddit example lived in one of these zones. Phoenix has a compounding problem. Rapid population growth created demand, but that demand came with unsustainable commute distances. A job in downtown Phoenix from Queen Creek is 38 miles. At current gas prices and vehicle depreciation, that's $14,000, $16,000 annual cost. Combined with Arizona's 3.55% property tax rate, household carrying costs are becoming untenable for middle-income households. Third, Nashville satellite communities, Franklin, Williamson County exurbs. Nashville experienced 31–39% home appreciation during 2019–2022 as tech companies relocated and remote workers arrived. But like Austin, the permanent remote work narrative evaporated. Now, a household commuting from Franklin to downtown Nashville daily is facing 35 miles each way, consuming 16–20% of household income just on transportation. Federal Reserve data on household debt and savings shows these markets have the highest vulnerability. In these three regions, the median household debt-to-income ratio is 2.48x annual income, compared to the historical post-recession average of 3.1x. That elevated leverage means even modest income disruption or job loss forces distressed sales. Here's the mathematical trap these markets face. Consider a household earning $95,000 annually in a Phoenix exurb with a $385,000 mortgage. Monthly housing costs, $2,100 principal, interest, taxes, insurance. Monthly commuting costs, $1,050, $200 vehicle payment, gas, insurance, maintenance. Total monthly burden, $150, $300. That's 40% of gross income on housing plus transportation. Traditional lending guidelines cap total housing at 28%. Adding commuting, an essential expense that lenders historically ignore in their calculations, brings total shelter and necessary transportation to 40% plus. That household has no financial flexibility for healthcare, childcare, or savings. When job market stress emerges and recession indicators suggest it's coming, households in these markets have two options: downsize the house or shorten the commute. Both lead to home sales. When homes flood the market, prices compress. Historical data on suburban market corrections shows 15–25% declines are typical in markets with high leverage and unsustainable commute distances. The timing signal we're watching is inventory and days on market data. According to Zillow, active listings in Phoenix exurbs increased 67% year-over-year from Q4 2023 to Q4 2024. In Austin satellite communities, active listings increased 54%. In Nashville exurbs, 38%. These are the leading indicators of price correction. Historically, when days on market double and inventory surges this rapidly, price declines follow within 6–9 months. We analyzed historical patterns from the 2007–2009 recession. Suburban zones with high leverage and long commutes experienced average price declines of 22–28% over 18–24 months. Markets with moderate commutes and lower leverage experienced 8–12% decline. The pandemic boom suburban markets align with the high vulnerability profile. One more critical data point. Fed Consumer Finance Survey data from 2024 shows that 42% of households in these three markets report feeling financially stressed about their housing and transportation costs combined. That's compared to 18% in lower commute suburban areas and 22% nationally. When stress levels are this elevated, It's only a matter of time before forced selling begins. What should these markets residents do? What should investors watch? For homeowners in these zones, research shows that the household from the Reddit post made the right decision, relocating to reduce commute distance before a correction hits. Selling into declining inventory and rising days on market typically results in 8-12% discounts. Waiting until the market is clearly falling often means 20-30% discounts. For investors and those tracking market cycles, these three regions, Phoenix exurbs, Austin satellite communities, and Nashville outer zones, represent the early stage correction opportunity we're monitoring. Historical recession patterns show that real estate corrections spread from highest leverage, least liquid markets first. These zones fit that profile. This is educational market analysis, not investment advice. Housing affordability and commuting